So, can the average person really get rich from investing in the stock market? Or is it just a game for the wealthy Wall Street insiders and Twitter finance bros? Today, we're breaking down what it really takes for the average person to build wealth in the stock market through investing, and seeing if regular people like you and me can build some wealth in the stock market. Spoiler, it's not about finding the next big bet that will rocket ship out of this atmosphere like Tesla. It's not about timing the market to get rich quick. Rather, we'll be talking about patience, strategy, and some of the boring old stuff. So let's start with some of the advantages of the stock market. Firstly, namely accessibility. Think about it, you got your smartphone, and with a few clicks on Questrade, Wealthsimple, whatever Webull platform you use, you can have an ownership stake in some of the largest companies in the country. Back in the day, grandpa or grandma couldn't even imagine the type of accessibility would have today. And then the magic of it all, one of the huge advantage is this access to compound growth. Right? Someone putting away a relatively modest $500 every month over the span of 30 years, getting a pretty realistic return of 7% a year, it's a good assumption, can rack up $600K in 30 years. You know, $600K is nothing to scoff at. It's a nice chunk of change. And you can play around with those numbers. You can increase the return rate, you can increase the time, and really see the snowball effect take off when it comes to compound growth. The other huge advantage of the stock market, aside from accessibility and compound growth, is ownership. Each piece, that's why it's called a stake. When you buy the stock, you have a stake in the company that you're buying into. You own a tiny piece of a large pie. That large pie is the business of whatever company you're investing in. And as these companies grow over time, so does your wealth. Longer term, there's a very good correlation with the profits that these companies will generate in 10, 20, 30 years, and the wealth, the share price of the stock that you own going up by that same or similar amount. The other huge advantage, I would say, is this access to passive income. And one of the first points I made was about accessibility, right? Even with just $5 in your pocket, you can get started and get investing. But into a dividend paying ETF or a company, then you get some money back every month or every quarter, sometimes half the year, semi-annually, sometimes annually. But regardless, the idea behind dividend is the company or the fund is paying you a share of the profit to hold that stock, hence the idea of passive income. So it's actually one of the easiest instruments, the stocks, to get passive income. So while there's some amazing advantages that we've been talking about, there are some risks and downsides that you really need to know about before you go off and become Warren Buffett. So one of the big risks with stocks, if you dabble in it, or ETFs, exchange traded funds, is the volatility. So for example, if we take blue chips, which is a fancy term for, the biggest, safest companies out there, for example, Walmart, in any given year in the stock market, it's very technical. They call it 52 weeks. They call it the 52-week high, 52-week low. If you take the difference between the high and the low of a blue chip, presumably stable stock, over 1 year, you can see from the high to low sometimes a 40-50% difference. So that shows you how volatile stocks and stock markets can be. And the reality is that Walmart's profits or revenues or the state of the company hasn't really declined or risen 40-50% in that time frame. It comes to my next point with risk. It's about emotions and investing. We're all people. Stock market, like anything else, is a market, and that market will be in many ways dictated by our emotions and our behaviors. So on any given day, the stock market could be overly pessimistic or overly optimistic, and that's reflected in the share prices. There's a lot of panic selling during downturns or FOMO buying during upswings, and people go crazy when they see their green and red on their Webull or Wealthsimple and their platforms. And with the phones, they're always hooked up to it, right? There's almost no barrier or break you can take. And because of their behavior and their emotion, the average investor actually underperforms the market itself because they're, doing the opposite of what they're supposed to be doing. The average investor is selling low and buying high, selling low, and it's really destructive. Often, the less you do in the markets, the better your returns. That's why there's a whole philosophy called buy and hold long term. The other one, and it's a similar point, I guess it's a disadvantage, is that stock markets and stock investing is so boring. It requires almost an infinite amount of patience. It's like watching paint dry or watching the grass grow. That's sort of the personality you need to be really good at this endeavor. And by no means the markets is not a get rich quick scheme or anything like that. And then there's the point that there really is no guaranteed return, especially in the short term. The research shows that in any 3-5 year time frame, we could have a down market, and markets could not be earning you much in terms of capital appreciation, even though you'd be collecting the dividends, and that will sort of pad some of your losses. But once again, no such thing as a free lunch or a guaranteed returns. But the good thing about the research is that it shows the stock market, especially when you look at particular markets like USA, Canada, over the very long term, 10, 20, 30, 50-year periods, have yielded positive returns for your money. Hence, as they say, it's always very important to diversify your asset classes, diversify your investments. And just a quick note, none of this is financial advice. I'm just some guy on the internet, right? And also, as someone who makes this content, it takes a lot of time and effort. So if you could please just smash that subscribe button, hit the thumbs up, leave an encouraging comment. It does really help, and I read all of them. So get to it. So, now we got the advantages and disadvantages out of the way. What are some tools you need to succeed if you want to get into the markets, into stocks and exchange traded funds particularly? The number one thing you can do is start early. Start today. And that's because when compounding, time is your best friend. Time gives you a long runway to compound your returns. And often these returns, if you look at a chart, they're like the exponential curve that goes like this. And in the beginning, it's slow, it's steady, but somewhere down the road, 10, 20, 30 years down the road, that exponential curve really takes off and your returns get absurdly fast. So start early, start today. Then the next tip is to be consistent. Whether it's 5, 10, 100, $500 a month, whatever you can afford to safely put away after you have some emergency saving for a rainy day fund, put that money to work in the markets or wherever you can get a decent return. Regular, consistent contributions are way better than timing the markets perfectly and getting in at the right time, or waiting too long to get in, or never getting in the first place. The other tool you need is diversification. As I was saying earlier, you don't want all your eggs in one basket. The other thing is stay informed. There's a lot of good business resources, websites. Today you have access to check out BNN, Bloomberg, Google News, whatever it may be, to keep informed on what's happening in the business world, the markets, etc., etc. And it's crazy that often people do so much research in other aspects of life. Peter Lynch, the great hedge fund manager with great return and track record back in the day of Magellan Fund, used to joke that people would get microwaves or fridges and they would do months of research just digging through the facts and stuff. But yet, when it comes to stocks, they go and hear some tip on the bus, they hear some random stranger talking about some stock, and within 10 minutes, they're calling up their broker and buying a boatload of that stock. So we have to do more research and be more prudent with our money, especially when investing. And then one last tip for you before we go our ways is to automate if you can, because human nature, life happens, things go on. If you have it automated, set it and forget it, you'll often come out successful. And then focus on things you enjoy. You might not be as passionate about the stock markets or personal finance as I am, tracking it, 365 days, 7 days a week, all day, every day. So, go on, focus on your hobbies, your actual passions, automate it, automate investing if you can. And it's really easy these days with the robo-advisors and the platform portfolios out there. So in conclusion, can the average person build wealth through stocks and the market? Absolutely, but it's not magic. It's not about getting there quickly. It's not about gambling, getting there very quickly, getting rich quick. It's about having a plan, having a strategy, and having some patience. If you're ready to start growing your investments and learning more, I've put out tons of videos on this channel. I have an entire series with God knows how many videos called Money Talks. You can check out that playlist and any other content that you like. And if you like what you see, it's totally free. So make sure to hit that subscribe button, thumbs up, like the video, leave a comment. Thank you. It will take you through the technical nitty-gritty of, which stocks, account types, exchange-traded funds to look out for, what's out there, and how to do it all, really. So yeah, thanks for watching, and a timeless reminder that time in the market beats timing the market. This is Tahmid, signing out for now.